Alright folks, let's get right to it. The market on June 9th and into the 10th was a real nail-biter. A classic tug-of-war between the bulls and the bears. You had to be watching every tick. This wasn't a market for the faint of heart, no sir. The big picture showed a split personality, a mixed tape that left a lot of people scratching their heads. One minute you think we're going to the moon, the next you're worried about a pullback. That's the kind of action that separates the winners from the losers, and you know which side we want to be on. Booyah! It's all about staying informed and ready to pounce on opportunity. So what was the final score? Let's break it down. The S&P 500, my friends, that broad measure of the entire market, managed to eke out a small gain. It was a grinder's victory, pushing just a little bit higher, but a win is a win. On the other hand, you had the Dow Jones Industrial Average, the 30 titans of industry, which actually ended up in the red. It took a little haircut, nothing catastrophic, but it tells you that some of the old guard big-cap industrial names were feeling some pressure. It shows you can't just buy the market and expect a uniform result, you have to be selective. Now where was the real action, where was the lightning? It was in the NASDAQ 100, baby. The tech-heavy index was the shining star, the undisputed champion of the day. It rocketed higher, leaving the other indices in the dust. This tells a powerful story. It says that innovation, technology, and growth are what investors are craving right now. They're not betting on yesterday's companies, they're putting their money on the businesses that are building tomorrow. This divergence is key. It's the market screaming at you where the momentum is, and you have to listen. Why the big split? It all comes down to what's inside these baskets. The Dow is packed with industrial and financial giants, which are more sensitive to traditional economic fears. The NASDAQ, meanwhile, is loaded with the semiconductor superstars, the software savants, and the biotech brainiacs. These are the companies that thrive on innovation and global growth narratives. When you see the NASDAQ outperform this dramatically, it's a massive tell. It's a signal that the market is sniffing out a specific kind of opportunity, and it's our job to figure out why and get in on the action. So, what lit the fire under the NASDAQ? 2 words: trade talks. That's right, whispers out of Washington and Beijing suggest that the US and China are getting back to the negotiating table. This is huge. For months, the market has been held hostage by trade tensions, but now we're seeing a glimmer of hope. This optimism sent a shockwave through the market, and investors started buying up the stocks that get hit hardest by tariffs and supply chain disruptions. When the 2 biggest economies in the world start talking instead of fighting, money gets put to work, plain and simple. The biggest winners? The semiconductor stocks, no question about it. These chip makers are the backbone of the entire tech ecosystem, and their supply chains are deeply intertwined with Asia. Think about it. They design chips in the US, get them manufactured in Taiwan, and sell them to companies in China. Any hint of a trade war truce is like a shot of adrenaline for this group. Names across the semiconductor space saw massive buying pressure. Investors were piling in, betting that normalized trade relations would unleash a new wave of demand and clear up production bottlenecks. This is where the real money was made. At the same time, we saw another crucial move. The US dollar got a little weaker. The greenback softened against other major currencies. Why does this matter? A softer dollar is like a global tailwind for many assets. For one, it makes US goods cheaper for foreign buyers, which can help our exporters. But it also has a massive ripple effect across commodities and even the wild world of crypto. When the dollar loses a bit of its muscle, investors often look for other places to store value. And that's exactly what we saw play out across the board. This weaker dollar was a blessing for industrial metals. Think copper, aluminum, and zinc, the building blocks of the global economy. A softer dollar makes these commodities, which are priced in dollars, cheaper for buyers using other currencies. This boosts demand from manufacturers and builders all over the world. So, while the trade talk news was the main event, the subtle dance of the US dollar was the critical undercard, providing a secondary lift to a whole different part of the market. You have to watch these currency moves. They're the secret language of global finance. Now don't get too comfortable because there's a big storm brewing on the horizon. All eyes are on the Federal Reserve. We have a trifecta of massive economic events coming up that could shake everything up. First, we get the Consumer Price Index or CPI report. This is the big one for inflation, telling us how much prices are rising for everyday goods and services. If that number comes in hotter than expected, you better believe the Fed will take notice. It's the market's report card on inflation, and everyone will be watching to see if we get a passing grade. Right after that, we have the main event, the Federal Open Market Committee meeting. This is where Jerome Powell and the gang at the Fed will announce their latest decision on interest rates. The market is praying for a dovish tone, maybe even a hint that rate cuts are on the table if the economy slows down. But if that CPI report is hot, the Fed might have to talk tough. This meeting will set the tone for the entire market for weeks to come. And don't forget, we also have the latest GDP update, giving us the freshest look at the health of the US economy. It's a week of high-stakes poker. This whole environment, a softer dollar and anticipation of what the Fed might do, created a perfect storm for cryptocurrencies. Bitcoin, the king of crypto, roared back to life. It surged past the 71,000 mark, posting a solid 2.5% gain. This wasn't just a small move, it was a statement. Investors are looking for assets that aren't tied to a single government's monetary policy, and Bitcoin is their go-to alternative. When the dollar looks shaky, Bitcoin looks mighty. It's becoming a legitimate macro asset, and you ignore it at your own peril. And it wasn't just Bitcoin having all the fun. Ethereum, the digital silver to Bitcoin's gold, also had a fantastic run. It climbed to around 3,700, jumping by more than 3%. The strength wasn't just in the big two either. We saw broad-based gains across the entire crypto space. This rally is being fueled by speculation that a softer stance from the Fed and continued dollar weakness will make digital assets more attractive. It's a risk-on move, a bet that the future of finance looks a lot different than its past. The crypto bulls are back in charge for now. So let's tie this all together. What's the bottom line? First, the stock market is telling a very specific story. It's a market of stocks, not a stock market. You can't just throw a dart. The strength is in tech, specifically in the semiconductors, which are riding high on the hope of a US-China trade deal. The old-school industrial names in the Dow are lagging behind. This tells you to focus on growth and innovation. Don't bet against the future. The Nasdaq is where the leadership is, and you have to follow the leaders. Second, watch the commodities. Oil prices got a nice boost from that same trade optimism, because a humming global economy needs more fuel. Crude is on the rise, and that's a bullish sign for global growth. Gold and silver were more muted, kind of treading water, but they remain a key hedge against uncertainty. Interestingly, silver prices in India were incredibly strong, showing robust local demand. Even though some other industrial metals saw small dips, the overall trend for commodities looks constructive, especially if the global economy avoids a slowdown. The bond market is sending its own signals. The 10-year Treasury yield, a benchmark for interest rates everywhere, is hovering around 4.45%. It ticked down a bit recently, which is what helped give stocks and crypto some room to run. When yields fall, it makes borrowing cheaper and encourages investors to take more risks. Keep your eye on that 10-year yield. If it starts creeping back up towards 4.6% or higher, that could be a major headwind for the stock market rally. The bond market is often smarter than the stock market, so listen to what it's telling you. Here's your homework. The market is mixed but leaning positive, with tech in the driver's seat. Crypto is strong, benefiting from a weaker dollar. Commodities, especially oil, are catching a bid on hopes for better global trade. But it all comes down to the big economic news this week. The CPI report and the Fed meeting will be the ultimate deciders. Be ready to act, stay nimble, and don't be afraid to take profits in your winners. There's always a bull market somewhere, and it's our job to find it. Booyah.